Okay, in this video we are going to forecast the property, plant, equipment at cost and its contra account, accumulated depreciation. Actually, the two rows of the forecast balance sheet. Okay, so the numbers here. And the three columns here are reported number of 2010 to 2012. These are forecast numbers. And the forecast of property, plant, equipment, we do not apply common size or trend analysis. The reason is we have more information and we can forecast a more accurate number. Okay, let's go back to the forecast development. Okay, so on the right hand side of the screen you can see the formula actually used for each steps, right? So for example, the number one, the red color formula actually applies to the red box in this spreadsheet. Okay, so the first we determine what's the net capital expenditures. So net capital expenditure is the difference, see here, between the property, plant, equipment acquired and the property, plant, equipment sold. This information are available in the date tab. You can find the information in the statement of cash flows. Okay, so we know the capital expenditure is an investing activities. So you can see these two rows, right? So this one is cash flow to acquire property, plant, equipment. And this is proceeds from sales of property, plant, equipment. Okay, so we directly refer the information or numbers from here. So the difference of the expenditure and the proceeds from sales is the net capital expenditures. Okay. The next is how to forecast the net capital expenditures for year +1 and 2 year +5, right? So actually we can base down two ratios. So let's go to the formulas of number 2. So that's the meaning of these two percentage. One is percentage of gross PPE, the other is percentage of revenue. So here the 12.1% represents, if the company has $100 total investment in total balance of PPE in prior year, so the company is going to invest $12.70 in the next year. Okay, so that's the percentage it represents. And here the percentage of revenue represents if the company make $100 revenue in current year, it spent $5.50 on investment in the property, plant, equipment. Okay, so these two percentage help us to predict the future net capital expenditures. Okay. So what we used is, see here, there's a 4.8. This is actually the average of these three percentages of prior 3 years. Okay, 4.8. So we keep using 8 and assume the company, will maintain this percentage for the next 5 years. Okay, so for example, in the next 5 years, from year +1 to year +5, when company make $100 revenue, it will invest $4.80 in the property, plant, equipment. Okay, see here from year 2 to year 5, all 4.8, right? But why here is a 4.4? Because 3,000 is given by the management in their MD&A reports. Okay, so if the number is given by the company, so we just apply the number directly. Okay, we do not make predictions if the company provide numbers. So that's why it is less than the 4.8%, it is 4.4%. Okay, the reason is 3,000 divided by the forecast revenue of year plus 1 is actually 4.4. Okay, see this formula is E101, actually 3,000. Net capital expenditure scaled by E33. E33 is actually the forecast total revenue of year plus 1. Okay, now these numbers except the 3,000, the rest actually is the forecast revenue of each year multiple the percentage of revenue in each year. Okay, so if I click one of the cells, you find it is a forecast. I forecast this is 105 F105 is a percentage of revenue. F21 is actually forecast F21 is actually in another tab. F21 it's just the revenue of year plus 2, right? Okay, so now we forecast the net capital expenditure from year plus 1 to year plus 5, right? So the next step is what's the ending balance of PPE and cost for the next 5 years. So this is easy. Take a look at the green formula number 3. The ending balance and cost equals to what? The beginning balance, right? The PPE and cost of prior year plus net capital expenditures. And we have already have the project net capital expenditures, so we just use it in this spreadsheet. For example, so in 2012, the ending balance of PPE and cost is 36,162, right? So the next year ending balance will be the balance in 2012 plus the net capital expenditure of year plus 1. So 39,162 is the ending balance of PPE and cost in year plus 1. Right. So if you click this cell, you can see the formula is, the total of these two numbers, and this one, the blue one, represents the balance of prior year. This one is actually the increased in or net capital expenditure in year plus 1. Okay, so all of these are the same, right? So the ending balance of year plus 1 will be the beginning balance of year plus 2. Then we add the capital expenditures, we get the ending balance of year plus 2, right? So we keep doing this for the next 5 years. What do we get? Is a balance of PPE from year plus 1 to year plus 5 at the PPE and cost. Actually, if you switch to the forecast tab, okay, so these numbers are actually direct reference from the forecast development tab. Okay, so the next is how to forecast the other one, the accumulated depreciation. So again, accumulated depreciation is an asset account, right? Because accumulated depreciation is a control account of PPE. Because PPE is an asset account, so its control account is also an asset account. Same as PPE, we start from year 2012. So next year, we're going to add the depreciation expense, right? So the accumulated depreciation of year plus 1 actually equals to the accumulated depreciation of prior year, actually 2012, plus the new depreciation expense. Right? So the problem is, what's the depreciation expense? The number in this row, right? Okay, so we should forecast the depreciation expense first. Okay, to forecast the depreciation expense, we simply just use a linear depreciation. Okay, we know the formula is here, like number 5. Depreciation expense equals what? The depreciation expense just equals to the book value of PPE, subtract the residual value divided by the number of years or useful lives, right? So we have the book value of the PPE, we don't have the useful life. So before we project the depreciation expense, we first calculate the useful life. We call it implied useful life. Actually, is in this area. Okay, what we do is first this row. Okay, it's same as this row, right? So the historical or reported PPE at cost, and we simply assume the residual value of property, plant, equipment are 0, right? And this actually is the average of the 2 years. Okay, and this is a reported depreciation expense. So the implied useful life, formula number 4, is actually the average depreciable PPE at cost divided by depreciation expense. Okay, so if we use the information for the 2010 and 2011, so the implied useful life is 13.8 years. In 2012, is 14.32 years. Okay, so we just keep using the most latest information. Just assume on average the useful life of PepsiCo's PPE is 14.32 years. Okay. So the next is to calculate depreciation expense. So first is the depreciation expense on new PPE, actually on the net capital expenditures for each year, from year +1 to year +5. This, right? The next is the depreciation of original or existing property, plant, equipment. Okay, so here we first calculate the depreciation expense per year for the capital expenditures from year +1 to year +5. Okay, so these 5 numbers are same as this 5. And for example, the depreciation expense of the first capital expenditure is 209. So actually, it is 3,000 scaled by the useful life. Okay, and because this expenditure occurs in year +1, so this depreciation expense only applies to year +1. Also, it applies to year +2, 3, 4, 5, later on to 14.32 years, right? The next one is capital expenditures of year +2, 3,410. Again, it is also scaled by 14.32 years, right? So on average, the depreciation expense of this expenditure is 238, and this expenditure starts from year +2, right? Because the company has not spent this money into year +1, so that's why this depreciation starts from year +2 and to later on. So this applies to the rest of the capital expenditures. So this calculate the this shows the depreciation expense on new PPE. Okay, and we should add the depreciation expense for existing property, plant, equipment. Right? Actually, it is here. Okay, and we know 36,162. This is the book value of property, plant, equipment in 2012. And again, we also assume the residual value is 0, right? So the annual depreciation is what? 2,525. Actually, it is simply just scaled the existing PPE at the cost of 2012 by the implied useful life. Okay. So from year +1 to year +5, the depreciation is 2,525 as a flat rate. Then the total depreciation is actually this row. This row, if you click one of them, it is just the sum of the existing depreciation of existing PPE and depreciation of new PPE, right? So that's for year +1. For year +2, the existing depreciation on existing PPE and the new depreciation. So now we have the depreciation for from year +1 to year +5, right? So we actually can apply this number in this row, and then we can determine the balance of accumulated depreciation. Same as property, plant, equipment at cost, the balance of accumulated depreciation is equals to the prior year balance. Okay, it's the balance of 2012 plus the depreciation, a new depreciation. So this is the balance of the accumulated depreciation. Okay, so it keeps changing, keep increasing, and the increase is the same as the depreciation per year. Now we have these two rows, and they are just our forecast of property, plant, equipment, and its counter account balance. Also here, one thing should be, so when you calculate the useful life, this information is available, okay? They are just from the data tab. Another thing is depreciation expense, okay? So depreciation expense, some companies do not report depreciation expense in their financial statements. For example, PepsiCo, right? So there is no depreciation expense in their income statement, right? No depreciation expense. The reason is they first capitalize the depreciation expense in their cost of goods sold, probably, and other actually is reported as part of SG&A expenses. Okay, so that's why PepsiCo does not report depreciation expense separately. So, but we can find out the depreciation in the financial statement notes. Okay, so you can search the notes to find out the depreciation expense. Company should disclose in the notes. If they do not, report in their financial statement, they should disclose in their notes. The other way is if you know the financial accounting teach us, we can calculate by comparing the difference of the accumulated depreciation, right? So the depreciation expense for year 2012, just the difference between the balance of accumulated depreciation of 2011 and 2012. Okay, so that's the forecast of property, plant, equipment.